Hi, everyone. My name is Dustin Miles. I'm with Momentum Multifamily. I'm excited to have Dan Rowley here today. Dan, if you could introduce yourself and then we'll kind of jump into it.
Great. Thanks for having me on, Dustin. My name's Dan Rowley. I'm a general partner with Spark Multifamily Investment Group. We focus on investments in Greenville, South Carolina, and the Greenville metro. In terms of my background in real estate, I started investing as an LP in multifamily syndication type deals in about 2018, 2019.
Okay.
Um, this was after I'd already been buying rental properties since about 2011. So prior to
Oh,
getting
wow.
into kind of syndication deals, I was buying and operating rentals, and we reached a portfolio of rental properties of about 20 units.
Oh,
At
wow.
the time, I was living in Northern California.
Mm,
Initially, bought some in California when the prices had really dipped. Got some on sale, but a couple of years later, prices bounced back, and it didn't make sense to buy any more in California. I started investing out of state.
right.
Texas, Utah, Idaho, a few other places. And the economics were working great. Obviously, again, I bought in at a good time in the market in hindsight. Um, but I didn't see myself going to maybe 40 units, starting to become pretty active.
Mm,
I had a day job, W-2 job at the time. I was CFO. So I had limited time. And so what appealed to me with these syndication type deals when I started investing was the passive aspect, right?
right.
And you
Right.
could diversify your holdings into different metros that you're interested in, or even different asset types. The bulk of my initial investments were in multifamily, but I've also diversified and done other investments in, industrial, self-storage, mobile homes, et cetera, just to get some
Mm,
diversification. But Class B type apartments has kind of always been my bread and butter and been my thesis,
okay.
right? And I've
Okay.
generally focused on high growth metros with strong demographics and strong growth trends, right?
Okay.
So most of my investments have been Sunbelt.
Right. Gotcha. Okay. How, when you were, great time to start investing in single family there, 2011. But so what did that did you, how did you buy out of state? I know there's different services and all that. Did you utilize one of those or did you kind of just, kind of figure out on your own what that looked like?
Yeah, good question. I think it was a little bit of both. So the initial ones I bought in Northern California, right, were right down the street. I could, touch and feel those and operate those. Then I started buying out of state. Some of them I just did my own independent research. I had maybe family in these places, so I had some
Oh,
familiarity
yeah.
outside Kansas City, Missouri, et cetera. So I could go there on a regular basis, get to know some of the neighborhoods. Um, a large number of the rentals I bought were actually kind of a turnkey offering. There was a company that was building build to rent communities
Mm,
and building small multifamily like triplexes, fourplexes. Individual investors could buy in
okay.
to a larger community. Say maybe it's 200 doors, but you can buy a fourplex or
Mm,
triplex or whatever.
that's
And
cool.
they also handled the property management aspect. So it was a kind of a turnkey offering. And these were
Okay.
pre-construction purchases. They were brand new units, townhomes. And again, very high growth areas like I was buying these in Boise and Salt Lake City kind of before they took off.
Right.
So yeah, good question. A little bit of both. So the turnkey offering was nice because you had to find your own property management and
Yep.
do all the homework. The developers did a whole lot of research, right? Obviously, on that this is a good place to build. The rents can support it. There's economies of scale when you build a big community. So that
Right.
was that was kind of how I got into it that way.
Okay. And for you, were those you got it bought at a great time, so hopefully there's some good appreciation there. But were those good cash flow or did you kind of, were there a lot of repairs so it kind of wiped out cash flow or what'd that look like for you?
Yeah, most of the stuff I bought was brand new, so there wasn't deferred maintenance, and so it was pretty predictable. And
Okay.
they were cash flowing out of the gate, um, at a decent level. But
Mm-hmm.
since then, right, I've owned these many years now. Some of them I bought in the 2014, 2016, 2018, that time period. And
Mm-hmm.
they've appreciated a lot, but the cash flows have increased as the
Right.
rents have gone up quite substantially. And I
Yep.
have fixed rate debt, right? 30-year fixed rate debt at pretty low rates. So the cash flow is really good. These are cash cows. That's why I'm going to under no pressure to sell them. They're providing a lot of good and steady income.
Yeah.
And
That's
as a
awesome.
sidelight, I guess just as a result of this income from these rentals and investments I've made in syndications and other investments, I was able to resign my day job last May, after working
Oh,
31 years in corporate finance.
oh wow.
So
Congratulations.
I do like and look for steady cash flow,
Yeah,
and it's worked out pretty well. Again, timing the market's hard to do, but it worked out pretty well in terms of when we bought a lot of these properties.
that's great. So you start out in single family, and then when did you kind of you started to get into multifamily? You said 2018, 2019. Is that right?
Yeah, that's right. That's when I really
Okay.
started to pivot. There was two aspects. One was, again, it was becoming pretty active.
Hmm.
And number two, it was harder to find cash flowing properties, right? As the
Yeah. Yeah.
values of properties kept going up, rents weren't going up as quickly. And I felt like there was maybe some better yield and cash flow opportunities in the larger commercial deals. At least that was
Right.
my sense at the time. So both of those things kind of motivated me to get into the multifamily
Okay.
syndication type investment.
And when did you because you live in North Carolina now, when did you kind of make that move from California to North Carolina?
Yeah, my family, which is my wife and two girls, two dogs, we moved in 2020, right during COVID.
Oh wow. Okay.
So at the time, I had been working hybrid. We went entirely remote. A lot of things were happening with COVID, and then we had a lot of wildfires in our area, et cetera. And we just felt like it'd be a good lifestyle change to move, and we found North Carolina to be pretty desirable. Kind of checked all the
Wow.
boxes for us.
That's
So we
a
moved in 2020.
Wow. That's a big move. That's I don't know how many thousands of miles, but that's yeah, you're exact opposite side of the country, right?
That's right. That's right.
Yeah. Wow. Um and you were in Northern California?
Yeah, we were in the San Francisco Bay Area in what's called the
Okay.
East Bay, east of Oakland.
Okay. Awesome.
Lafayette, California was the town we lived in for a number of years before moving
Okay.
here. Yeah.
Awesome. Okay. Yeah, I think I admit maybe I mentioned to you I lived in Northern California just for a year. I
Oh
lived in
yeah.
San Mateo.
Oh yeah.
Yeah, and I've only been to North Carolina. I guess maybe only once, but yeah, I remember driving through Cary. Anyways, it was a while ago. It was a long time ago, but I don't know. It's I remember that. Um, and so you kind of got into multifamily 2018, 2019. Was that more on the passive side, or was that you starting to, were you a GP and putting that? When did that kind
Yeah.
of start?
Initially, I was just LP, and then I started
Okay.
to get more interested in the business model. I started to listen to a lot of podcasts, kind of educate myself on how these things are put together.
Okay.
Listen to stories from a lot of operators. And I
Okay.
did have interest in doing GP stuff, but I didn't right away. So I invested maybe 2 or 3 years like that as an LP.
Okay.
And I began to attend, some trade shows like the Best Ever Conference.
Right. Right.
Started to kind of meet other people, network. And it was at the 2021 Best Ever Conference that I met my current business partner, Arn Senendello,
Oh,
the founder
cool.
of Spark Investment Group. So, uh,
Wow.
we started talking. I initially invested with he and Brian in some of their early deals. I could see they knew what they were doing.
Yeah.
Um, we shared investment philosophies, and we just formed a relationship over a couple of years. I invested with them, got to know them, went down there, got to know the market. Greenville, South Carolina is a very dynamic, high growth market. A lot of exciting things are happening, and then it just kind of made sense as I had more interest. They kind of had a need for somebody with my kind of skill sets, right? And I think that's key in this business, is to find people with complementary skill sets so that you can cover all the different aspects of running a business, right? And
Yeah.
so they had, they were doing everything, but they weren't really maybe thrilled about some of the admin and financial stuff that needs to be done. And as you grow, you get more of that, right? So,
Yeah.
so I kind
Yeah.
of handle all the financial and admin aspects, right, of the deals.
Okay.
And in addition, I sign on the loans with them and I raise capital. We all raise capital, but
Yeah.
I kind of had skills they didn't have. They had skills I didn't have. So together we're there's synergies there, right? So
That's
in
great.
about late 2022, we started to work together on deals. And since then, we've done about 10 deals, eight syndications, two JVs.
Oh wow. Okay.
Yeah.
What is your deal size box? What do you'd mentioned Class B earlier? Is that still kind of what you guys go after? And then if you could kind of touch on where everything's located and maybe just on operations and all that too.
Yeah, yeah, good question. So yeah, our primary market is definitely the Greenville, South Carolina market. Um, Both Arn and Brian, my partners, live there. Brian owns a residential property management company, and he has for
Oh,
15 years. So he manages 600 units or so.
wow.
So we focus on sub 100 unit properties,
Okay.
multifamily. So these are ones that don't have on-site management. So we roll those into what Brian manages, and there's obviously great alignment when you got an owner that is managing them, and his
Yeah,
management company does a really good job, obviously.
that's
A couple
great.
of things that would bear that out is last year our portfolio was occupied like 96%,
Wow,
minimal
that's
bad
great.
debt. And so he really knows how to manage properties in that market. So we feel like that's a big home court advantage, right?
Yeah,
To have the
yeah.
management kind of in-house.
Well, yeah, not. I agree for sure. And I also think it gives you guys a unique advantage because they both live there. It sound I maybe they're from there. I'm not sure, but just having boots on the ground, own management company, and I think that's the way because typically you need like we go after 150 units and higher, but we're local to our areas, but we hire third party, and so but like for instance the third party, their minimum unit count's 150, 200 units.
Mhm.
And so they've done some stuff a little bit smaller for us, but to your point, you guys have in-house management and you're geared towards being able to do that sub 100, which sounds like it works really well for you guys, and he's got it set up for that, so that's awesome. And then you don't have to necessarily compete with some maybe silly money that's coming from out of town because they're going to want bigger stuff to make it kind of worth their time. So
Yeah, that's
that's
certainly another valid aspect that I was going to mention, but you beat me to it. Is
oh
probably a
sorry.
bit less competition with the smaller stuff. The institutional
Yeah.
money is generally going after bigger stuff. They
Hmm.
don't want to mess around maybe with some of the smaller properties. And also there's, maybe there's tired mom and pop operators that own smaller stuff that,
Yeah.
we can find, favorable terms when we purchase. So there's advantages of operating smaller ones.
That's great. What it for you guys, or I guess for the other two guys, was anyone in a mentoring group to kind of get going, or did they just? I mean, I know the one guy has owned, I think Brian has owned a management company for a long time, so maybe he used, like, hey, I'm gonna just start buying stuff, and so I didn't know if there was a formal coaching program or whatever, or if they just kind of, learned as they went.
Yeah, it's a good question. Yeah, Brian, he came up from the trades, building, plumbing, owned property management.
Hmm.
We were able to plug him in effectively. He's really just focused on property operations. Arn Senadello, my partner, he has, before he got involved in multifamily, he'd been a residential broker in real estate for over 40 years.
Oh, wow.
So he had an
Okay.
extensive knowledge already. In addition to investing himself, he did a lot of flips, a lot of buy and holds, a lot of transactions. Also was an LP, so he understood real estate. So he didn't really need coaching on that. In fact, he does some coaching on that. But
Hmm.
I think he did get some help on kind of the marketing, for syndication. So I think
Hmm.
he took a program that helped develop the website and the database for mail lists, right? The newsletters,
Right.
kind of how you get yourself out there and
Yep.
market yourself,
Yep.
and how, maybe some of the back end stuff in terms of managing this stuff. So he did get help with that because that was a new aspect. Um, so I think the marketing, the internet site, communication, outward facing stuff, posting a lot of videos and content. So that he had help with that aspect. I haven't taken any coaching programs per se, but
Okay.
again, before I got involved as a GP, I had quite a bit of experience owning real estate, operating real estate, kind of the full
Right.
gamut, right? As well as a lot
Right.
of financial background. that was easily transferable, right? And in fact, real estate's a much simpler business to manage than some of the internet businesses and so forth that I'd done. As a CFO for. So I like to, I don't want to say simple, but it's much more tangible and simpler to account for
Right.
than some of the
Right.
other businesses out there, and a lot easier to value and underwrite for. I mean,
Yeah.
I want to
Yeah.
say when I can underwrite one of these projects, yeah, if I'm off more than 5 or 10%, I probably haven't done a good job. If you're within
Right.
5 or 10% of your forecast in an internet business, it's practically a miracle, right? Because there's just it's just such a different dynamic, and there's so many
Yeah.
different moving pieces, and yeah.
Wow. That's cool. In what, so you guys are sub 100 units typically. Are you what vintage, and do you guys try to kind of cluster things together? What does that kind of look like?
Yeah, we bought, I think we focus on kind of the affordable tier of rentals. And in Greenville, South Carolina, that would be maybe 1,600 unit, $1,600 a month or less.
Okay.
Um, there's obviously been new Class A stuff that's being built and new stuff being,
Sure.
developed. It costs more than 2,000 a month. But we feel like a good place to be is the more affordable rentals. So if you run into some economic friction, people can still afford those rents. So we bought 90s vintage, 2000, 80s. We're under contract right now for some 80s product. That's definitely affordable, and we're going to get a tax abatement on that, and that really boosts our returns. But I
Oh,
would say in general, it's the affordable. We've also bought new product, kind of smaller, new build townhomes and duplexes,
uh-huh.
1,100 square feet,
Okay.
two bed, 2.5 bath, no garage, and we can rent those for 1,500, $1,600, brand new product.
Wow.
Um, right outside Greenville. And so we bought those from developers. We're not developers ourselves, so we like to buy. So we
Okay.
buy at the certificate of occupancy in that case, and then we lease them up and operate them. So we like
Right.
the new stuff for the same reasons that I liked when I bought my own,
Right.
fourplexes and townhomes, is that there's no deferred maintenance. You know what you're getting. It's brand new. Generally speaking, a tenant's going to prefer to live in a new unit versus an old unit, even if it's been heavily
Sure.
renovated, right?
Yeah.
We aren't stuck on one particular vintage, but kind of the affordable element is kind of what we key in on, right? It's not to say we wouldn't buy something to rent it for 1,800 if the numbers make sense, but we have stuck so far with rents usually between 1,100 and 1,600.
How long have you guys been doing the tax abatement stuff? Is that relatively new, or have you guys been doing that for a while?
We were co-GPs on a bigger deal in Greenville in 2022 that was tax abated. So we have that
Okay.
experience. We know it can work and how it works and kind of the mechanics of it, right? But we're not in charge of that deal. That's a bigger deal.
Yeah. Okay.
But we have exposure to it for sure because we're co-GPs on it.
Okay.
And since then, we haven't done any co-GP deals. We've just done our own deals. So this deal that we're doing right now would be the first that's our own that we're doing tax abatement on.
Oh, okay. And I don't, are property taxes a large line item on the expense side in South
South
Carolina?
Carolina, they actually are. Yep.
Okay.
Yeah. North Carolina is not, it's more like 1%. There can get closer
Oh,
to 2%. It's come more like a Texas.
okay.
I mean, if
Okay.
you live in South Carolina as a resident, your property taxes are quite low. They get a very generous homestead exemption, right? If you live there. If you're an
Okay.
investor, you don't live in a property, they're a decent line item to be accounted for. So the tax abatement definitely helps.
Okay. And do you guys have to put a certain number of your units at certain AMIs or certain income thresholds, or what does that look like?
That's right. Um, in this case, 75% of the units have to be with income qualified tenants.
Okay.
Some at 60% AMI, some at 80% AMI.
Mm-hmm.
But the reality on this project that we're closing on soon is that we even have headroom. So the rents are low enough that we're not even
Right.
bumping
Yeah.
into the AMIs. We have $100 or $200 headroom. It's still going to be administratively, there's a lot of work to be done there, but
Sure. Yeah.
we can raise rents and still be within the guidelines. And then in this case also, we have to partner and have a very slight ownership with a nonprofit. And again, that's
Okay.
all kind of the nuts and bolts that we figured out how that works in our prior
We
deal. And
We've closed on a few tax abatement deals ourselves, and so kind of similar to what you're saying. So for us, so we're most of our stuff is 2000s product, and and we have the areas that we buy, and the household incomes are pretty healthy for the
Mhm.
area, and so the 80% AMI is like you mentioned, we have quite
Yeah.
a bit of headroom there. It's the 60% AMI that depends on the deal and all that kind of bumps into where our rents are currently. So we may have a little bit of rental loss there, but our taxes, as mentioned, are a big thing here. Our tax rate is usually around, I don't know, 2.5, can be a little bit north of that, but kind of, it's probably a good ballpark number.
Right.
And these are pretty big deals, so our tax numbers,
Mhm.
usually anywhere between 400,000 and about, I think our highest one's 1.3 million. And so, if we're if our taxes can go away, our NOI, jumps up pretty quick. So
Yeah,
good for
you
you
get it.
guys.
Sounds like you get it. Yeah, you're dealing with it. I know that Texas and South Carolina, and there's a few other states that have fairly high taxes where this would make a bigger difference to implement versus some of the
Yeah.
other states. If you go to Alabama, it doesn't make sense because your taxes are like 0.5,
Oh,
less
wow.
than 1%, So
Wow.
so it
Wow.
is it's a kind of a suitable thing for different markets that
Yeah.
have higher taxes, right?
Is is that a long process to get approved? Is it with the local, like, is it with the city or the county, or what does that look
The
like?
state program, we apply with the
Okay.
county.
Okay.
We're this initial partial year of ownership that when we buy, we're gonna have to pay the taxes prorated. And
Sure.
then we
Yeah.
apply and next starting in 2026, it'll be tax abated.
Oh, cool.
So that's kind of how that works.
Yeah. That's awesome.
Um, yeah, there's something else I was gonna say, but it escapes me. But yeah, I think
Is
we've covered the abatement piece. That's a kind of some special sauce there, right? That can be
Yeah.
used.
Yeah. Is there much of a approval process with that, or is it just kind of you apply and you'll get approved, or
Yeah, I mean, as long as they audit the rent roll and so forth, as long as comply with all the guidelines, there's no issues getting, you know,
awesome. That's
as
great.
per the current law, that could change down the road. None of that's in concrete, right, for years out, but
Yep.
the way it's currently in place, yeah, we don't anticipate any issues getting it
That's great.
implemented.
Awesome. What does so for the this year and all that? What does this year look like? You said you're under contract with a deal. What does kind of this year look like for you guys? Are you putting the deals that you buy? Are they fixed rate debt? Do you guys do you do bridge? Like what does some of the financing side look like?
Yeah, we this is going to be this deal I'm talking about, tax abated deal. That's going to be agency debt, and that gives us pretty attractive interest rate because this is already a stabilized property.
Yep. Yep.
Also I'd say it's a strong risk adjusted returns because we don't have to do a heavy value add. We're going to do some light renovations, right, and lift
Sure.
the rents a
Yeah.
bit, but we don't need to get rents from 1,100 to 1,400 in 2 years, right? That's just not part of our business plan.
Yep.
So just kind of let the market rent, raise rents and renovate units as they turn. And the cash flow should be healthy because of the abatement and the lower interest rate, that we get with agency debt. We have not done, to your earlier question, floating rate debt. I think my partners and I tend to be a little bit old school, a little more fundamental.
Mhm.
And that's not to say we never would do it, but we haven't. And as we've seen, right, there's bigger operators who've certainly gotten in trouble doing it.
Yep.
And they
Yep.
were, um, kind of to make deals work for a while when things got kind of euphoric, right? They had, get a higher down payment, higher loan LTV, floating
Yep.
debt. They got into a lot of those deals, and obviously a lot of those deals have suffered. So we'd rather. I think the other aspect is that we'd rather just be a little patient, take what the market gives us. We're not, and we don't have some big goals on assets under management or number of doors or
Right. Right.
we want to just be slow and steady growth. I'd say would be our mantra. A couple deals a
Yeah.
year. and just develop slowly. I don't personally subscribe to kind of the 10x mentality, and I don't think my partners either do. We're a little bit more experienced in life, and we don't always be as busy as somebody who's trying to 10x their business, right? We don't want to work 60 hours
Right.
a week. We want to have
Yeah.
work-life balance. We enjoy what we're doing. We enjoy partnering with investors, helping them, grow their money. We enjoy the, aspect of providing good, safe, quality, housing for people.
Yep.
And so we
Yep.
feel good about what we're doing, but we're in no hurry to kind of go big, go fat, go big or
Yeah.
go home. So I think that's helped us. We were able to just kind of be more patient through this latest cycle and stick with fixed rate debt, stick with smaller deals where it made sense. I think there's some deals we were kicking tires on 2 or 3 years ago that we're certainly glad we didn't buy
Right.
because
Yeah.
the
Yeah.
numbers in hindsight would have been pretty tight, right? So
Yep.
we'd rather be patient and pick our spots, I would say.
Yeah. Yeah. There's yeah, I can relate to that. There's plenty of deals where, that are kind of coming back up and we're like, oh, pretty steep discount to where we were at before. So
Yeah, yeah,
uh
exactly. If you hang around the hoop,
yeah.
you might
Yeah.
see obviously some really attractive pricing versus what you were able to see a couple of years ago. And then,
Yeah. Yeah, there's a few deals that just come to mind. We've seen from where the pricing was before to now. I
yeah,
mean,
yeah,
the stuff that we buy is kind of in that, I'd say 130 to 200K door is where
mhm,
stuff kind of lands at, where we're at. And the stuff that was kind of on the upper end is now 30, $40,000 per door lower than what it was kind of being whispered before. So definitely making it pretty attractive and all that. So um,
yeah. I mean,
it
we've all seen the similar dynamics. 20% lower, 25% lower
yeah.
than what we would have had to buy at a few years ago. In fact, the properties that I'm talking about, the tax abated properties, it's a three property portfolio, 96 units total.
Oh
We've
wow.
been looking at those, or Arn has, even 2, 3 years ago, we were underwriting those
Yeah.
and we
Yeah.
couldn't find a place that made sense.
Hmm.
And then the seller, that their situation changed and they finally felt motivated enough to sell. And we got a lot better price than we would have. And so, yeah, that's just an example of what you're talking about. I mean,
Yeah.
we're certain we were looking at these. We're glad we didn't pull the trigger then. It makes more sense now.
Yep.
And the
Yep.
investor returns are going to be a lot healthier as a result.
That's awesome. Is there anything you'd kind of like to, before we kind of wrap up, is there anything you'd like to share with our audience, or just kind of any, tips or just anything that you've kind of learned? You've been doing this for, started in real estate, a while back. And so, yeah, anything that you'd like to share, I'd love to hear it.
Yeah, I think there's maybe a couple takeaways for investor types that might be listening to your podcast. One is that I've learned even more going through this process. I think it's very important to know your market and have experience operating in your market and really understand it. So again, Brian's been managing properties there 15 years. He knows every street and every neighborhood and where not to buy, where to buy. So these are things. I mean, we've seen a lot of operators that are big and expanding. They go from one in market to the next, and next they're in Houston, and then they're in Phoenix, and then they're in Charlotte, and then they're in Nashville, and they're like they
Yeah.
can't possibly have expertise in all those markets. And certainly they might
Yeah.
be partnering with people, but I think we've seen some people get over their skis and then they've struggled in new markets because they didn't understand all the dynamics. So understanding your market, kind of living there on, breathing it, boots on the ground, as you put it, that's, I think, more important than I would have even realized a few years back, right? I
Yep.
think it's a
Yep.
very important element. So that's something I would look for in operators if you're looking to invest in. I think that's a real big advantage. And the other thing is, just understanding the risk factors in deals, right? I mean, I've seen inexperienced maybe LPs look at deals and say, this new development deals, projecting an 18% IRR and your deal's 15%. Well, why would I go with you? Well, those are
Right.
completely different deals, right? And the
Yep.
level of risk in a new development deal, as many are seeing in the last couple of years, maybe not so much 4 or 5 years ago, but now last 2 or 3 years for sure, is a lot of things can go wrong, right?
Yep.
And
Yep.
18% on paper doesn't mean much if you can't get the building out of the ground, right? Or you run out of
Right.
financing and any number of things, or you have to keep putting capital in. So I think people need to understand that there's different levels of risk. We focus on risk adjusted returns. Like if we're taking over like this current deal I'm talking about, it's already stabilized, it's already above 90%. We feel we will do better because of the property management, but there's not a
Right.
lot of risk. We're going to do light value add. We don't have to boost. I mean, so that's a completely lower risk project. And we're not going to give you an 18% IRR, but we're going to give you maybe a 14% IRR. But the risk adjusted return and the ability to maybe sleep at night a little easier, knowing that, we got agency debt on it. So just the deals are different, is my main point.
Yeah.
And that people
Yeah.
should, earlier on in my investing life, maybe I didn't understand that as well either, but I would say people should understand the risk level, and you do need to be compensated on returns for higher risk, right? So
Yep.
just
Yep.
just kind of understanding that risk adjusted return element.
Yeah. No, that's a really important point. Yeah, I remember I've had in the past people are like, "Oh, I'm looking at two or three deals," and they're like, you're to your point, we were I don't remember the IR, but let's just call it 16%, and the other guy was at 18 or 20, and I'm like, well, we're at the property every week. Like we own a property down the street. Like we've been here for a while and know what to expect. And I don't know. I didn't review the other guys' stuff, but there's some folks that and I benefited from it too, kind of in the 2000, call it 13, 14, up to COVID basically. It was really easy to operate.
Yeah,
And
yeah,
a lot of people were buying, to your point, were buying stuff all over the country and all that. No, and a lot of times, not all the time, but sometimes there were no boots on the ground there. Um, and in a lot of people, because the market was going up and cap rates were going down, and so you're probably okay, because the all the tides were rising and kind of bringing everybody up. And then once COVID hit, and higher interest rates and all that, and operations and insurance got hard, and just everything was a lot more difficult, and rents have been flat, at least for us, for really 18 months to 24 months. And so, the past 5, 6 years been really challenging just from a operations perspective. And that's why, that's part of what, some of the folks that have not done so well lately, it's, they bought these deals all over the country, and there's no one there to check on them and all that. And that's I think a really important, aspect of risk, to your point. So,
yeah. That's
um,
well put. That's good context. I mean, I would echo that it was remarkably easy for a little while to invest in these deals and
mhm.
see your money, maybe 2, 3 year hold,
Yep.
30,
Yep.
40% IRR or more better than that, right? It was just kind of like the rising tide lifts all boats, right? But then the
Hmm.
tide has come back. And so now you're able to see kind of who are the really the operators interested
Yep.
and didn't take unnecessary risk, right? And so that's becoming more evident.
Yeah.
And and it's hard to raise capital now. So I mean, if
Yeah.
you don't have if you haven't been able to manage your deals properly, it's probably even harder to raise capital. We're fortunate enough to have some really good return, a lot of repeat investors, people that have been happy to continue to invest. But that's not to say, these people have constraints. They're not going to be able to invest in every deal. You got to continue to cultivate new investors as well if you want to do more deals. But
Yep.
it's a particularly interesting time because there's, all this uncertainty. And when people are uncertain, they hold on to their money in general,
Yes.
right?
Yeah.
And
Yeah.
so I think it's challenging right now. But if you have the right deal and the right track record and the right business plan, I think it's doable. But I think people need to kind of also adjust if you're on the GP side, right, adjust your expectation on how
Right.
much capital is out there because if you haven't raised money for a couple of years, it might be surprising, right?
Yeah, yeah, yeah. You might be in for a little bit of a shock. So,
Yeah.
yeah, the days of just throwing out one email or one webinar and it just fills up or are gone.
Yes.
There's a lot
Yes.
more follow up and work and all that stuff. So,
Right. And I think as it should be, right? Yeah.
yeah, 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 yeah. It got too. I think things were a little too easy, a little too loose. So. Well, great. How do people reach out and chat with you? How do they potentially invest with you guys? What's the best way to get a hold of you and just learn more about you guys?
Yeah. I mean, I welcome anybody who wants to call me. I'm at 925-917-4802. My email is dan@investwithspark.com. Again, dan@investwithspark. I'm happy to have a conversation with anybody, whether or not they're interested in investing or just want to talk
Awesome.
multifamily. I'm always happy to compare notes with people and network with people because it's an industry I found where people are willing to share and it's
Yeah.
collaborative, and that's an element I like about this multifamily.
Yeah. Yeah, I think it's kind of I know I had been around some other industries that were not that way. They were very much had their walls up and so yeah, it's yeah, very very welcome and lots of really just good folks in multifamily and it's a lot smaller community than people think. So but
It's true.
well, awesome, Dan. Well, really appreciate your time. Everyone, please be sure to reach out to Dan. Super nice guy, very knowledgeable, very sharp. They've got a really good operation going in South Carolina. And yeah, appreciate your time, Dan, and hope you have a great day.
Thank you. Appreciate
All right.
it.
Thanks, Dan. See ya. Bye.